Welcome to Ask an Advisor, where we here at Team Clark go deeper on all things investing, helping you save your money so you can retire early if you want and retire happy, which is Wes Moss's
my primary goal
specialty.
in the world.
Yes,
Yeah,
I love that.
goal.
I think about it a lot now. So, and today, Wes, you are going to talk about a couple of things. One is there's so much going on in the news all the time. So why is the stock market doing so well? Is that about right? And then also estate planning and how that can go very wrong.
Awry. It can go awry big time.
Yeah.
Even if you have a great plan in place, and this was prompted by a listener who emailed in and said, hey, how could there be such a mess with all these celebrity estates if they're so buttoned up? So we'll talk about that too.
It can get so ugly. Yeah. So we all should be doing our estate plan, even if it's a very simple, nothing going on right now in your life and you're young. I think it's so important to always think about it. Clark always says that because none of us want to think about death.
1,000% not. So let's start with the economy.
Okay.
As opposed to thinking about death. This is, I was writing about this earlier in the week with the thought that there's really two economies and there's one stock market. And again, if you watch financial television like I do 24/7, you're always hearing different opinions about things are good or things are bad, or the market should not do so well. The market has more room to run. And 2025 has been a really, not an extraordinarily strong year for stocks, but pretty good. It's been a really strong year for the S&P 500. And we've also seen some broadening out beyond just the S&P 500, which is, we know, is very tech heavy. So we've seen strong performance from financial companies, industrial companies, utility companies. So there's been some real broadening out. But the question is, what's happening in the real economy and the Main Street economy? And I would just start this by saying that the stock market and its performance can very often be disjointed from what's happening in the economy. We can have a good economy and a bad market. And I think what we're seeing today is a really good market and just an okay economy. I'm not going to say the economy's bad, but what's driving, we're in an interesting position. What's really driving and what always drives stocks is earnings. That's the first principle of all equity investing. If earnings rise in any given year, it's pretty hard for the stock market level not to follow to some extent. Earnings expectations early this year were somewhat muted in the single digit range, but what we've seen so far in 2025, and remember, this is despite all of the geopolitical events we're seeing. We've had this massive back and forth about tariffs starting in March and April, and that's still not resolved. That's a lot of noise around that. We've had this great back and forth because of the tariffs with big trading partners like China. We've had meetings with Russia. We're dealing still with the Ukraine war. We've got fighting between the White House and the Federal Reserve. So if you were to look around, there are lots of flies swirling all the time, and they're noisy. I would say there's lots of noise, and the noise is noisy, but the stock market has done well. And the question is why? Well, instead of having earnings up single digits, earnings from this time last year are up 11, 12, 13%, which is really, really strong. And that's from the corporate side of the ledger. So think companies and how they do versus the everyday American trying to get a raise or keep a job. And those are a little bit divergent right now. So we've seen second quarter earnings come in now that we're in the third quarter of the year. And again, really strong numbers, up 11, 12% in aggregate. We've seen companies and again, these are not buy, sell, hold recommendations, but we've seen companies like Monster Beverage as an example, doing more with less. We've seen big logistics companies do more with less. And what does that mean? Well, it means that, yes, we've seen revenue numbers go up, but we've seen profit numbers go up even more. And what does that entail? It entails companies hiring less. And it entails companies maybe either laying some people off because now they're implementing technology that makes them more productive. And they're doing it, one of the phrases I read this week is human light. They're just doing more with less people. And when you have less people, you're paying out less, so your profit margins are higher. And there's been a lot of increases in margin this year, which means companies are doing things more efficiently, which is code for they're doing it with less people. So companies are doing really well. In aggregate, up 11, 12% in earnings. That's really good, but a lot of that is them squeezing more out of their business and doing it in a more cost-effective way. Now, take a look at continuing claims or jobless claims. I looked at both this week, and if you look at continuing claims, I'll put my glasses on here, and I went to the Federal Reserve Economic Database and looked at continuing claims. These are people that have filed for uninsurance or filed for unemployment. They're collecting insurance, and they're looking for a job, but they can't find a job. So this is this is not a bright spot in the economy. And if you go back to the beginning of 2024, we had about 1.7 million people that were unemployed looking for work. Now that's a little over a year and a half ago. Today we have 1.95 million. That's a 13% increase in the amount of people that are out there looking for work. So that's not a great economic number. So there is this thought of, well, how can companies be doing well and the stock market's doing well, but the real economy is a little cooler than we'd like it? Now, the unemployment rate is still low, but we've seen a real slowdown in hiring, and we've seen more and more companies talk about, hey, we had really good profits. Our earnings are good. That's what matters to stock prices most of the time, but we're doing it with less people. So that's not so good for all of us as Americans. So I think there's a reminder that the stock market is one thing and the economy is somewhat separate. Now, over time, you've got to have a strong economy to eventually have good earnings and eventually power stocks higher, but they don't always have to move in perfect lockstep. And we're seeing that this year. Mm-hmm. Really good stock market, I would say just an okay economy. And that's just the reality, I think, as investors we have to accept. And note that as an investor, what the market has been doing is tuning out the noise. And the market has essentially said, well, yeah, there's all these issues, tariffs and geopolitics and fighting with the Fed and where are interest rates going? And the market said, well, yeah, those are all not great things, but we're really focused in on what matters, company earnings, and those have been really good.
Great. Are you ready for some questions?
Let's throw them at me.
This one came in from Connie in New York. My question for Wes is about when you have company stock in a 401k. My Fidelity financial advisor told me I need to roll over all of my 401k to a managed account to utilize the NUA. My company stock is only about 10% of that account, but has a significant value. Can I just move the stock portion of the 401k out as an NUA? Perhaps that is Fidelity's way of building managed accounts.
Connie, yes and no.
So what is an NUA, just to make sure?
We covered this. I don't remember what it's been a while.
Just to make sure everybody knows.
NUA, as a quick reminder, is the rule of net unrealized appreciation, and it only applies to folks that have their own company stock in a 401k. The NUA rule essentially says you can take you can choose, and you have to run the calculation on this, but you can choose to take your stock and take it out of a retirement account and put it in a brokerage account. So it's out. Mm-hmm. You end up paying ordinary income rates on the stock's basis. So imagine if you have $100,000 in a stock, but your basis is only $5,000.
Right.
That's a situation where NUA might really make some sense. So you pay your ordinary income taxes on that basis of $5K. And basis is what it was when you originally were given that stock, or what your cost basis is over the years,
exactly.
Which can evolve. And then you only pay taxes at the long-term capital gain rate when you choose to sell that stock. Mm-hmm. And for most people, the long-term capital gain rate is much more favorable than your ordinary tax bracket. So it could be for family. I was looking at a family situation where a family had $125,000, $130,000 in overall income. Some of it was from long-term capital gain. They were able to stay in the 0% long-term capital gain bracket. Mm-hmm. So imagine it's really a tax arbitrage between your long-term capital gain rate. Remember, those brackets are 0, 15, and then 20%. Not many people are in that really high long-term capital gain bracket. Most people are in the 15% and even 0% long-term capital gain bracket. So that's how NUA could work. Now, Connie, the rule is your advisor is correct. You can't just take out the stock portion. In the year you do NUA, you do need to roll the whole 401k amount out. Now, it doesn't need to be at the same time. For example, you could roll out the stock in March, but by the end of the year, the rest of the account has to go in. That the non-stock portion would be rolling into an IRA so that you avoid paying taxes on it. So you would be looking at a direct rollover potentially there. But what they're saying, it doesn't need to be in a managed account. I think that's the nuanced word. That can be in your own account, that's self-directed IRA that you manage. It doesn't have to go into a particular managed account. So maybe some miscommunication with the advisor there, but they're right in saying in the year you do NUA, the whole retirement account from work does need to go somewhere, all in by the end of that calendar year.
Okay, we're going to go to Jake's question. Jake's from North Carolina. I'm currently 59 and a half, and I want to retire at 63. I'll have no debt. Currently, I make $65K a year. We have $115K in an old target retirement IRA, no contributions happening at Schwab. $62K at my current employer in a target retirement 401k, and then another account with a Vanguard fund with a brokerage with a 9.5% contribution of income. 3.5% of that is the company match. I have $10,000 in a Roth IRA at Vanguard and only $50 a month. I'm only contributing $50 a month. I have $25K in a brokerage account with 2 stocks in it, and $22K in a 3.5% online savings account. My goal is to pay my house off in 2 years, then purchase a car and work the last year to pay it off. My currently vehicle has 300,000 miles. Wow, Clark would be very proud of that.
We're all
Jake.
proud of that. What kind of car is that?
I know. I am a single co-parent of 2 boys that will be 12 and 16 when I retire. Their mom and I expect them to work and pay for college and transportation, and we will help as needed. My question is, at retirement, should I start drawing from my retirement accounts until they're depleted or almost depleted, then take Social Security? If I start drawing Social Security along with my retirement savings, would that work? I live a very frugal life and should be able to easily live on about $3K a month after taxes during retirement. Social Security will be around $2,300 at 67, full retirement age, $2,900 at 70, or $1,800 if I take it at 63. I've tried to use online calculators, and if nothing happens, my retirement funds should last about 7 or 8 years if I start drawing from them at 63. Any advice would be greatly appreciated.
First name here again?
That was Jake.
Jake. Yes, I do. I was scribbling down notes.
You're a note taker.
To try to keep up with these dollar figures, and I'm getting to about $220,000 for Jake. The most important numbers that he discussed: 59 and a half, 63, 12, 16, 63, 67, 70. There's just those.
A lot of numbers.
It was just those. And what I'm seeing here is that Jake wants to be a really early retiree, and I love that. He's 59 and a half, wants to retire at 63. So that's 3 and a half years from now. What is maybe most important about this question, Jake, is the age of your kids. They're going to be, in 3 years, 12 and 16. So they're really little now. They're 9 and 13. They're super young. And you were eyeing retirement at 63, but your 63 amount, your age 63 amount for Social Security is only $1,800. And if you wait till 70, it's $2,900, which makes sense. So I'm just looking at this, I'm saying you've got a $250,000 in assets approximately. And yes, you could probably bridge and utilize that until you wait for Social Security. But I just think you're a candidate to wait for Social and maybe work a little longer. This whole scenario, yes, it sounds like you're super frugal. $3,000 a month? I mean, that's super low in spending. But if it were me, I would be thinking, my kids, these kids are not even going to be out of the house when I'm 63. 12 and 16 when you're 63. So Jake, my advice, maybe it's obvious, is to be working a little bit longer so that you're not having to tap that $250,000 in savings just yet. And in the meantime, the cool part about you waiting for social is it gets to the point where it almost will cover all of your expenses for the rest of your life. And I know you don't want to work longer than that, and I usually advocate retire sooner. Mm-hmm. But I think you're a candidate to work a little bit longer and wait for social. That's my take, Jake.
Matt in Texas says, I am 39, aiming to retire between 50 and 55. I'm married. My wife is 33 with a 2-year-old and another child due in October. We have $850K at Vanguard, $345K in a rollover IRA, $170K. This is part of the Vanguard thing. $345K in a rollover IRA, $170K in a Roth IRA, $110K in a 401K, and $105K in a taxable brokerage. My wife has $70,000 in her 403B, $51,000. We have $51,000 in an emergency fund, and we have $20,000 in 529 plans. We live well below our means. My grandfather, who's 93, retired at 50 and now has $4 million. My parents, 73 and 71, their net worth is $7 million. My question is too much of my portfolio tied up in retirement accounts, limiting access before 55? Should we prioritize funding a 457? If my wife decides to leave, we'll have access to those funds, and or continue investing in our taxable brokerage with excess funds. I would inherit $500K when my grandfather passes. I'm totally not taking into account any of my parents' inheritance, as it's hopefully 2 decades plus away.
So Matt, if I'm keeping track of these numbers roughly, you're at about $1.5 million saved at least. That's just you. Then another 170 of the 403B. This question, Matt, is about early access. You're young. Your wife's young, in your late 30s, and you're eyeing a super early retirement, 50 to 55. So I would be thinking about when you can get access to money without penalty. This is all about that. And there are a lot of different ways to do it. The rule of 55, think about that in your 401k. But again, in order to qualify for that, you have to leave service of that job at 55 or later. So that may not work if you're in your 50, if you want to do this at age 50. The rule of 72T in your retirement accounts. You can those are substantially equal payments that you can turn on early, but they've got to go all the way until you're 59 and a half or 5 years, whichever is longer. So 72T could work for you here. The other thing that could work is the 457. If that's a 457 government plan for your wife, that has a special provision where you can access that at any age, if it's a government 457. So I like that idea. That gives you early access to money. Otherwise, the other thing that, Matt, you're saying is that $500,000, I mean, your grandparents are in their 90s. So it's not out of the realm that 500 at some point in the next 10, 15 years, you would have some inheritance as well. And remember, that would be tax-free money, and you'd be able to access that in a really favorable tax rate and scenario. So I think you have enough different assets to be able to do that. I like the 457. Remember, if you do have an inheritance, that'll be available to without penalty to get to for the most part. And then you can always use the rule of 72T on some of these IRAs if you go way before the age 55. But your scenario is all about early access. And I think we just talked through a couple of the main ways to do that.
Okay. And straight ahead, we're going to be back very shortly, and you're going to talk about estate planning.
It's estate planning. It's not Jimmy Buffett. It's about Davy Buffett. Straight ahead.
Okay.
Welcome back to Ask an Advisor. Wes Moss, along with Krista DiBiase, here to continue to ask listener questions, which I've been loving lately. And we want to start with, we're talking estate planning gone awry.
Yes.
Estate planning gone awry. And this came from a listener who I think just referenced Davy Jones from the Monkees. Hey, hey, we're the Monkees.
Yep.
And one of our producers here is young enough to just say, who are the Monkees? What is
I
that?
know. Gosh.
And I said, Chris and I were sitting here singing, hey, hey, we're the Monkees. And she still said, no, don't. I said, they were the mini Beatles. Is that a good way to say it?
Sure.
They're kind of like the Beatles, but like 90% less than the Beatles. They had one or two good songs.
Yeah.
Anyway, there was been articles about Davy Jones, one of the Monkees, that had an estate, and there was a big estate planning fight. There's another article about how Jimmy Buffett, who obviously had a giant estate, had a big estate fight, even though he had a bunch of estate planning done. And the question was a smart one, which is, hey, if you're doing all this estate planning and you're buttoning everything up, why are there still all these issues?
Sure.
So I thought, well, let's talk about estate plans gone awry. So instead of talking specifically about Davy Jones and Jimmy Buffett, I just made up a character named Davy Buffett. So think of him as a musician with lots of money. And act one of this story is essentially that he's really good at estate planning, really conscious. So he did a revocable trust and living trust, named his wife and his business partner as the co-trustees. So he thought long-term wife, best friend, business manager. So they're the trustees. He did a will, everything poured over into the trust. The personal property, and they even labeled that. Who gets the guitars? Who gets the boat? Who gets the vacation house? There was even a no contest clause in his will, which is if you contest this, then you're going to be left out of the inheritance, or at least in some regards. And then updated it. He was good about updating. That's probably one of the hardest things to do is once you do an estate plan, people just don't want to revisit it. You don't want to. It's like, I already did the estate plan. I don't really want to go back and do it again. So he even did that. So everything's buttoned up. Sounds great. But then the dispute begins because Davy Buffett passes away. And now all of a sudden everything's ready to get settled. And now he has co-trustees. He really trusted both of them, but they have totally different opinions on everything. So the wife wants things to move really quickly. The trustee business manager wants things to be drawn out. There's a fight over where royalty payments go. The conflict number two, well, what's the vacation home? He had a place in, let's call it Nashville, in a place in Florida, and let's call it a place in the Keys, a cottage. Well, the wife said, well, his vacation home goes to me. Well, the girl said, well, that's not his vacation home. That was his primary home. He was mostly down here, and that's our vacation home. So there can be a dispute over how we label things. And imagine how easy that dispute would be. The other thing is that things change over time. Maybe primary home was in Palm Beach, and he wasn't in the Keys a lot. But over the years, it kind of flip-flopped, and now there's a dispute. Well, which one was really the primary, and which one was really the vacation home? Well, that's my home. So next thing you know, that's a conflict, and then that goes to court. Then, and this is not unreasonable because this has happened. I think there was a case with maybe Aretha Franklin where this happened. There was another will that wasn't discovered until after things were already getting.
Oh, gosh.
There was a couch cushion will.
Oh, no.
And it said, no, I'm going to leave this one particular condo in Nashville to my son. Well, wait a minute. The main will didn't say that. What was the date on that? When did he sign it? Was he in his right mind?
Oh, exactly. The being in your right mind thing, people contest that a lot.
Davy Buffett in his right mind. So he's got everything planned out, but now there's this human toll with court battles, hundreds of thousands of dollars spent on lawyers. You've got family relationships that get fractured and people start arguing over all this. Even if you have the most buttoned up estate plan, it doesn't mean that people can't sue and trustees can't get along, maybe don't get along, and heirs say, wait, that's not fair. So you get this, in this particular hypothetical musician story, you've got co-trustees clashing. You've got some vague wording. Vacation home ended up being vague. Stray older documents that created confusion. And then probably the main thing that I've seen in practice over all these years, and I'm not an estate planning attorney, so this wills and trusts are for an estate planning lawyer to draw up. not a CFP, is that humans or heirs can always sue. That's really what this boils down to. So if somebody feels as though this is unfair for any reason, courts usually listen. Courts usually say, okay, well, maybe it was unfair. And then once you get into court, it just becomes really expensive, and it gets very long and drawn out, and things get delayed. Now we're in court. Well, we can't distribute the assets because we haven't decided on this. And now lawyer fees are $50,000, $100,000, and nobody's distributing the money because it's still tied up. And this person over here, the son has a pretty good case that the condo's his, and the girls have a pretty good case that was the primary home and not the vacation home. So humans can make this messy really easily. And that's why you'll see these stories and you think, well, this guy was a half a billionaire or a billionaire. And he had great estate planning attorneys and he still had trouble. And that's because humans are complicated. Estate planning, I would say, is as much about the people as it is the paperwork. And that's just the reality of the world we live in. We live in a society can be super litigious, like it or not. That's part of the legal system we live in. And it can be super frustrating, and it can derail even the most buttoned up plan. So how to avoid it? I don't know if there's any way to perfectly avoid any conflict in the future after you pass. But upfront communication before you pass. Nobody really likes to talk about these estate documents, but if you do, it really does clear the air. 1, 2, be really specific so that there's not terminology disruption once people are reading the will, and make sure there's no old drafts, signed, unsigned, laying around. That's going to create absolute havoc. So you can get it really buttoned up, and most of the time, actually, in real life, things do go pretty smoothly. But we're going to see from time to time these high-profile cases where things have totally gone awry.
Yeah, I was going to say, I can imagine if it's really complicated, almost doing a videotape of a meeting with whoever you're leaving stuff to and explaining to them who's going to get what, and just...
That sounds like the beginning of a murder mystery film.
I mean, I
think it makes it even more complicated. Did somebody doctor the
video?
The video with AI, Krista?
I don't know,
Now I'm even more confused.
Yeah, the communication is huge, though. I think if somebody feels blindsided, they're more likely to get even more emotional at a very emotional time anyway. All right, we'll go to questions. Lisa in California says, how do you like E-Trade accounts? It seems to have great investment options, high yield savings and checking. Is this, I don't know if I'm saying this right, Trefis investment research tool a good one? How do you like the high quality portfolio which outperforms the S&P 500? My advisor said target retirement funds are not good since they become conservative based on retirement age, even when the market's down. How does Wes feel about this?
Hey, Lisa. Here's my thought on, I don't know how to pronounce it either. It's Trefis, or I think it's Trefis. And first of all, E-Trade. I don't use E-Trade. E-Trade was one of the giant discount brokerage firms like Charles Schwab or Ameritrade, and now there's been a ton of consolidation in the industry, and now they're owned by a really giant Wall Street type firm, Morgan Stanley. So I don't really know exactly how well that's been integrated. It's been a couple of years, but let's just assume it's still a low-cost, self-directed option for you, which I don't see as there's really not a huge difference between what they do and the cost of being able to access the investments you want versus a Schwab or Fidelity. So I don't know that there's any inherent disadvantage for being at E-Trade. I just don't use it. I've used Schwab, Fidelity, Vanguard for most of my life. So that's where I'm most comfortable. But again, I'm not saying there's anything wrong with E-Trade. The other thought is that platform, which I've seen this and read about it a little bit in the past, but it's a very interesting research tool. It's not the kind of, it's not a replacement for a portfolio manager. It doesn't say buy these 10 stocks. What it does try to do is allow you to do your own research and modeling and say, well, I want to find companies that have this amount of free cash flow and this net debt to EBITDA and this sort of this sort of earnings growth or dividend growth. So you can model the kind of companies that you're looking for, and it acts as a screener to help you find that. You can also model out what earnings might do in the future, I believe, for different companies, and really do your own research. It's a tool for you to identify the companies that you feel comfortable investing in. It doesn't surprise me that they have baskets that are pre-screened. Maybe I don't know of this one, but the solid balance sheet, healthy company scenario where they're saying, here are the metrics we're using and these are the companies, and they did a back test. Remember, it's a back test in the past about what companies have done well. So there is no perfect crystal ball here. It's actually really easy to come up with a portfolio if you're it's super easy. You just pick a couple of the best performing stocks and they're included, and you look at what those metrics are. Next thing you know, you've got this wonderful portfolio that's crushed the S&P 500. Question is always, what is going to happen, Lisa, moving forward? And there is no perfect crystal ball. AI can't do that for you. A research tool can't do that for you. But it does empower you to invest in the kind of companies with the kind of metrics you feel comfortable with. So I see no issue using it, particularly if you like being active in your investing. And as far as the target date portfolio, I'm not totally against target date funds because I think they are an easy button to help people be invested, and that's better than not being invested. Mm-hmm. Do they get usually too conservative, in my opinion, by the time you get to retirement, then get even more conservative and they end up 70, 80% in bonds, which I think that is not necessarily the right call for a lot of retirees. Yes, I think they do. But there are plenty of years when a target date fund has a nice balance of risk assets and safety assets. So they can be good, but just like any other fund, you need to understand what's under the hood. What's in that target date fund? What's the allocation? Okay, I understand it. I'm comfortable with it for the next couple of years, but it may not be forever.
Okay. Chris in Missouri says, I'm a retired 25-plus year Navy veteran, thank you for your service, and currently work in the tech industry in Kansas City. I have a guaranteed military pension. My wife and I have been diligent savers for our entire working lives, but lost focus and got our buckets of money out of whack in that we have nearly $2 million in retirement, but underfunded our brokerage and liquid savings, dry powder, resulting in us having to take out a mortgage for our home, and we're stuck paying 6.25% interest. It's crushing to me to be wasting so much money per year in interest that we will never get back. We purchased for $625,000, put $100,000 down in August of 2024. We currently owe $520,000. We can afford the payments, but with so much money in Roth IRAs, Roth TSP, should we withdraw our contributions, avoiding the penalties to pay down our home faster? Should I pay it off today? Do it in chunks or take another approach? I don't want to be normal. I want to be extraordinary. I love that.
Chris, I think you're already extraordinary.
Yes.
25 years in the Navy, extraordinary.
Wow.
$2 million saved in IRAs.
Oh my gosh, that's unbelievable.
Extraordinary. $520,000 on a mortgage. Yeah, your rate's higher than you'd like it to be at 6.25%. But it's also not, having a mortgage is not some morally wrong thing. I mean, it's a financial tool to spread out payments to avoid a tax tsunami of pulling a whole bunch of money out of retirement accounts. Now, in your case, you have lots of Roth money, so as long as you've got 5 years and you're 59 and a half, you could take out some contributions, it sounds like to me, and pay this off early or sooner. But now you're taking $500,000 out of your savings in order to pay off a mortgage early. And I just think about the loss of compounding for that. And I don't know, and it just feels a little bit forced in order to do that. One of the ingredients to being a happy retiree is having your mortgage pay off within sight. Mm-hmm. It's not necessarily paid off. It's paid off within sight, meaning within the next 9 years, which is a long window. Now, it sounds like yours may be a little longer than that. But I would be looking to, if you're going to use your contributions and you can pull them out, without worrying about the 5-year rule or the 59.5 rule, which you should be able to do, it sounds like, then you may just accelerate your payments. And we know that if you're accelerating your payments, maybe an extra $20,000 a year, $25,000 a year, maybe that cuts down the mortgage significantly. But who knows? Are you really going to be in this house forever? If you are, and this is your forever home, then I would be thinking about maybe paying it down a little extra every year. But again, this is just my opinion on it. I don't know if I'd be rating my retirement accounts. Certainly not regular 401k IRA money, pre-59.5. That's a tax tsunami you just don't want to deal with. That makes the 6.25% mortgage look like a friendly walk in the park. But even if you do have mostly Roth money and you can pull out your contributions, you're also taking away from your retirement compounding. And remember, your house should slowly appreciate as well. So it's not the worst asset in the world either. Or probably. I don't know your exact town where you are in Kansas, but I wouldn't look at having a mortgage as a moral failure. I would look at it as a tool that you can accelerate by accelerating the payments a little bit, but I'm not in the camp of you just taking all the money out and paying it off right away.
Okay.
You are extraordinary, Chris. That's a pretty awesome situation to be in.
For sure. Tracy in Florida says, thank you for going over the ways to access your retirement funds before 59.5. I have a question about both Rule 55 and 72T. Can either or both of these be utilized for accessing Roth funds, a Roth 401k for the Rule of 55 and a Roth IRA for 72T? We are retiring in the year we both turn 55 and are wondering if we'll be able to access our Roth 401k funds from the employer we're leaving this year, or just our traditional 401k funds without penalty. In addition, if we wanted to use 72T to access our IRA funds, can we do that from our Roth 401k or just our traditional? Thanks for all the wisdom you provide. I'm glad you've been added to the show. I've read your books and can't wait for any future ones you may be working on.
Oh,
and
thank you,
are
Tracey.
working on
I am. The Retire Sooner method. Tracey, I think the simple answer here is the Rule of 55 does work for the 401k and the Roth 401k. So you're good there. The Rule of 72T will work for traditional retirement accounts, IRAs, but they don't apply, at least my understanding, is they don't apply to a Roth IRA. You can't use a 72T early distribution. The rule on taking money out of that Roth 401 or Roth money is having it for at least 5 years and being 59.5 to be able to access both the contributions and the growth. So I think you're pretty close to this. Also remember that, so think of the retirement accounts at work. That Rule of 55 is a really powerful rule, and you can use it for regular IRA money or regular 401k money and Roth 401k money. And if you still haven't left work, which I don't think she has yet, and you're going to make it to age 55 at that employer, consider being able to roll funds into the 401k so you have more money in that to access it with the Rule of 55. So just remember that as a possibility. Look, there's always a lot to think through with these decisions, and I'm only getting a snippet of your full situation, but those are some of the things I would consider from what you're asking.
Great. Well, that does it for us today in this edition of Ask an Advisor.
No easy questions today. No easy questions.
If you do have a question, you can go to clark.com/ask and you can indicate whether your question is for Clark or Wes. Clark will be back tomorrow. Hope the rest of your day is fantastic, and thank you so much. Please share this episode with a friend if you think they would enjoy it. We appreciate everyone who subscribes and likes our videos and our audio podcasts. And thank you so much, Wes.
Thank you, Krista.